check is late, it is never late. 7:42 a.m., a widow refreshes her bank app and sees nothing. No deposit, no explanation, just silence. For years, the fund promised safety, capital protected, income steady, built for people who could not afford risk. Widows, near retirees, survivors living on schedules tighter than their budgets. The money arrived every month like clockwork. Small but dependable, just enough to breathe. Behind the scenes, the timing mattered. Payments went out only after new deposits came in. Older investors were paid first, newer ones waited. The structure was called laddered, the language sounded conservative, the mechanics were not. When questions surfaced, answers softened. Liquidity, administrative delay, market timing. Then the phone stopped ringing, emails bounced, withdrawals piled up. What looked like safety may have been motion. What felt like income may have been other people's savings. And when the ladder broke, there was nowhere left to stand. Chapter 1. Stakes. The pitch never sounded risky. It sounded careful. The Widow Fund was introduced as a retirement pool built for people who could not afford mistakes, widows living on survivor benefits, couples a few years from leaving work, retirees who needed income they could count on. The language stayed simple. Safety, preservation, monthly income, no exposure to market swings. Presentations happened in quiet rooms, community centers, church halls, small financial planning offices. The organizers spoke slowly and did not chase excitement. They warned against stocks. They talked about volatility like it was a disease. They framed the fund as an answer for people who had already lost enough. The structure was described as conservative lending. Pooled notes, short-term placements, staggered maturities, money coming back in waves, not all at once. That was the ladder. It sounded orderly. It sounded managed. There were no glossy brochures, no promises of growth, just steady checks and the idea that principal stayed intact. The first deposits came in modest amounts, $50,000, $75,000, $100,000 from a life insurance payout. Each investor signed a subscription agreement that emphasized stability and control. Withdrawals were allowed, but encouraged to follow a schedule. Monthly income was the point. Pulling everything at once was discouraged, framed as unnecessary. Early investors received their first payments exactly when promised. The checks arrived on time. Direct deposits hit accounts on the same day every month. No delays, no surprises. Confidence grew quietly. Word spread the way it always does in these circles. One widow told another. A financial advisor mentioned it to a client who was nervous about the market. The phrase safe income started to repeat. Internally, the fund kept no public filings. It was not registered as a mutual fund. It operated under private placement rules. That detail was mentioned only if someone asked. Most did not. By the end of the first year, the pool had grown. New investors replaced old ones naturally, or so it appeared. Money flowed in, payments flowed out, the system looked balanced. What no investor saw was the absence underneath. There was no external yield engine, no loan portfolio producing consistent returns, no assets generating enough income to cover the monthly obligations. The outgoing payments were real, the incoming profits were not. Instead, deposits followed a rhythm. New money entered the pool in predictable cycles, often near the start of each month. Payouts followed shortly after. The timing was close enough to look coincidental. It was not. The laddered structure allowed staggered obligations. Investors were not all paid on the same day. Some received income on the 1st, others on the 15th, a few at the end of the month. That spacing reduced pressure. It prevented visible strain. As long as deposits exceeded withdrawals, the system held. Questions did come up. A widow asked how the returns were generated when markets were flat. The answer was technical and calm. Short-term lending, conservative counterparties, nothing speculative. The explanation satisfied her in the moment. Another investor asked for documentation showing where funds were deployed. He was told the details were proprietary. Disclosing them would compromise the strategy. He accepted that answer. He had already received 6 months of payments without issue. The fund relied on that trust. Each on-time payment reinforced it. Behind closed doors, the organizers tracked cash daily. Not returns, cash, incoming wires, scheduled withdrawals, expected deposits. They knew exactly how much money had to arrive to meet obligations. The latter was not an investment strategy. It was a scheduling device. When one investor delayed a deposit, payments were shifted. A check moved from the 1st to the 3rd. An excuse was prepared in advance. Banking delay. Administrative processing, no one pushed back hard. The first real stress appeared quietly. A long-term investor requested a partial withdrawal outside the normal schedule. Not a full exit, just enough to cover medical expenses. The amount was not large, but it disrupted the balance. The request required cash that had not yet arrived. The organizers asked for time. They cited liquidity management. They offered to split the withdrawal into installments. The investor agreed. The payment was delayed by 2 weeks. No complaint was filed. That delay was logged internally as a warning. At the same time, new deposits slowed. Market fear was not the cause. Competing products were. Higher interest rates elsewhere. Investors had options. The Widow Fund was no longer the only place promising safety. To compensate, outreach increased. Calls were made, presentations scheduled. Advisors were encouraged to bring clients who wanted income without risk. The language sharpened slightly, still conservative but more urgent. Another compliance issue surfaced. A document required for certain investors was incomplete. It was supposed to disclose how returns were generated. The language used was vague. It had passed review before. Now someone noticed. The issue was discussed internally and dismissed. The form would be updated later. The payments were still going out. That mattered more. No regulator had called. No subpoena had arrived. From the outside, the fund looked stable. From the inside, it was a balance sheet problem disguised as a calendar. By the end of the second year, total investor contributions had reached several $1,000,000. The obligation to pay monthly income had grown with it. The latter required constant replenishment. One organizer raised the question directly. What happens if deposits stop? The answer was short. They will not stop. That belief shaped every decision that followed. No reserve was built, no contingency planned. The assumption was momentum. Trust would sustain the flow. The widows needed income. The advisors needed a product. The checks would keep coming. The risk was not market collapse. It was math. Each month required a fixed outflow. Each outflow depended on inflow. The latter concealed the dependence, but it did not eliminate it. An investor noticed the language in her statement had changed. The word guaranteed no longer appeared. It had been replaced with expected. She asked about it by email. The reply was polite and non-committal. Regulatory wording update, no change to performance. She accepted that explanation. The check arrived 2 days later. By the time the first investor seriously questioned the source of the returns, the system was already strained. Her question was simple. Where does the income come from if no one is borrowing at these rates? The answer avoided specifics. Diversified placements, rolling instruments, conservative partners. She asked again. This time the response was delayed. That delay marked the moment when trust began to fracture. Not publicly, not yet, but inside one investor a seed took hold. She shared her concern with another widow. The other widow had also noticed a change. Her last payment arrived later than usual, only by a day. But it had never been late before. The ladder was starting to slip. No one knew it yet, but the fund was no longer paying income. It was paying time. Chapter 2, Escalation and Reversal. The pattern did not break all at once, it stretched. The first missed payment was not called a miss. It was framed as a delay, a processing issue, a timing mismatch between banks. The explanation arrived before the concern could harden into anger. For most investors, the money showed up within 48 hours. That was enough. But the spacing mattered. Payments no longer landed together. Some arrived early, others drifted. The ladder that once felt orderly now felt uneven. Inside the fund, daily cash meetings became routine. Incoming wires were tracked against outgoing obligations hour by hour. The organizers no longer talked about returns. They talked about coverage, who had to be paid today, who could wait until tomorrow. The laddered structure made the stress manageable. Not everyone was due at once. By shifting a few payments, they could buy time. That time depended on deposits. Deposits slowed further. Financial advisors grew cautious. Clients were asking harder questions. Interest rates elsewhere were climbing. Safe alternatives existed. The widow funds stopped being a default recommendation and became a conversation. To counter that, the organizers leaned on their strongest angle: stability. They reminded advisors that the fund had never missed a payment. They emphasized track record over explanation. That worked until it did not. One investor, a retired teacher, requested a full withdrawal. She had received a small inheritance and wanted to consolidate her finances. The request triggered a problem the latter could not absorb quietly. The amount exceeded the cash on hand. The response came quickly and sounded reasonable. Withdrawals of that size required notice, 30 days, possibly 60. The paperwork allowed it, the teacher agreed. She had no reason not to. Internally, the fund did not have 60 days. To cover the future obligation, the organizers needed new money now. Outreach intensified, calls became more frequent, presentations promised peace of mind, the word conservative was used more often. New investors did come in, smaller amounts, enough to cover the next cycle, not enough to fix the underlying problem. The teacher's withdrawal was split into parts. The first installment arrived late, the second arrived later. She called. The tone on the phone was calm but strained. Liquidity management, market timing, she was told everything was fine. Around the same time, an advisor requested detailed documentation. A client wanted proof of where funds were deployed. The request was not hostile, it was professional. The response took days. When it came, it was thin, high-level descriptions, no transaction-level data. The advisor flagged it internally and stopped recommending the fund. That decision mattered more than the organizers realized. Fewer referrals meant fewer deposits. Fewer deposits meant less room to maneuver. The latter required precision. Precision was slipping. Inside one bank, a compliance officer noticed the pattern. Regular incoming wires followed by clustered outgoing payments. The amounts did not line up with any disclosed investment activity. The officer filed an internal report. No one from the fund was told immediately. Investors began comparing notes, quietly at first. One mentioned a delayed payment to another. Another shared an email that had gone unanswered. The sense of individual inconvenience started to feel collective. The language from the fund shifted again. Safety gave way to patience. Investors were asked to trust the process. The checks were still coming, mostly. Then one did not come at all. A widow waiting on income to cover rent refreshed her account all day. Nothing, no notice, no email. When she called, the line rang longer than usual. When someone answered, the explanation sounded practiced. System upgrade, temporary disruption, funds would post shortly. They did not. That missed payment triggered withdrawals, not all at once. A few investors requested partial exits. Others asked for timelines. The latter could not handle simultaneous pressure. The organizers met and made a decision. Payments would be prioritized. Smaller accounts would be paid first to reduce noise. Larger withdrawals would be delayed with paperwork and policy language. That choice bought days, not solutions. Behind the scenes, bank accounts thinned. Transfers were moved between institutions to avoid overdrafts. Internal emails grew sharper. The math was now unavoidable. There was no pool of assets to liquidate, no reserve, no income stream. The only money left was what had not yet been paid out. A regulator noticed the compliance report. Subpoenas were prepared quietly, requests for bank records, transaction histories, communications. The inquiry did not start with accusations, it started with questions. The fund received notice of the requests late on a Friday. By Monday, withdrawals had spiked. Word travels fast when money stops moving. Investors were told the inquiries were routine, reviews happened all the time. The language was careful, no admission of wrongdoing, no specifics. The latter broke that week. One payment failed entirely. Not delayed, failed. No funds available. The bank rejected the transfer. That rejection echoed through the system. Emails flooded in, phone lines jammed. Advisors demanded answers they did not have. Widows who depended on the income faced immediate gaps. The organizers drafted a statement. Temporary suspension of payments. Liquidity review underway. Commitment to transparency. The words arrived too late. By the time the suspension notice went out, the numbers were clear. New deposits could not cover existing obligations. The fund was insolvent in everything but name. The regulator moved faster. Accounts were frozen. Transfers halted. The ladder that once hid the dependence now exposed it. Without inflow, there was nothing left to distribute. Investors learned the truth in fragments. A news article, a call from an advisor, a formal letter from a regulator. Each piece confirmed what the silence had already suggested. The income they trusted was not yield, it was circulation. The reversal was complete. What began as a promise of safety had become a race for position. Who would recover something? Who would recover nothing? The widows who entered last faced the worst outcomes. By the end of the week, the fund's website went dark. Emails bounced, phone lines disconnected. The ladder had not failed suddenly. It had worked exactly as designed, until it could not. The question was no longer whether the fund was real. It was how much damage had already been done, and whether anyone would be held accountable. Chapter 3. Resolution and Aftermath. The freeze made it official. When the regulator announced the action publicly, there was no more room for interpretation. Bank accounts tied to the widow fund were locked. Transfers were halted. Any remaining cash was preserved for review. What investors had feared in private was now stated in formal language. The fund was described as a laddered Ponzi. New investor deposits had been used to pay existing obligations. There was no underlying business generating returns. Monthly income had come from circulation, not yield. For many investors, the announcement was not a surprise. The silence had already told them enough. For others, it landed like a blow. Some had defended the fund to family members. Some had moved most of their savings into it because it felt safer than the market. The language of protection had worked. The damage became clearer as records were reviewed. Bank statements showed a simple pattern. Money entered, money left, almost immediately. There were no long-term placements, no loans producing interest, no assets held long enough to justify the steady income that had been promised. The latter had staggered payments just enough to disguise the dependence. It had spread obligations across days and weeks. It had slowed panic. It had bought time. Once inflow stopped, there was nothing left to manage. Investigators reconstructed the timeline. Early investors had been paid in full, often receiving more than they contributed. Later investors had received partial income before the collapse. The last group had received almost nothing. Losses were uneven but severe. Retirement accounts were drained. Insurance payouts meant to last decades were gone. For widows living on fixed income, there was no way to replace what had been lost. The organizer response followed a familiar script. Public statements denied intent. The fund was described as misunderstood. Market conditions were blamed. Administrative errors were cited. The language avoided the core issue. Transaction records contradicted those claims. There was no evidence of market exposure that could explain the shortfall. There were no failed investments to point to. The structure had required constant deposits from the start. Emails obtained during the investigation showed internal awareness of the dependency. Cash flow concerns were discussed. Payment timing was managed carefully. There were references to needing new money to cover obligations. The language was cautious, but the meaning was clear. Civil actions followed. Investors filed claims seeking recovery. The prospects were limited. Most of the money had already been distributed as income payments to earlier participants. What remained would be divided among many. The regulator outlined potential charges: securities fraud, misrepresentation, operating an unregistered investment vehicle. The process moved slowly. Accountability in financial cases often does. For victims, the timeline mattered less than the outcome. Some adjusted quickly. Budgets were rewritten. Homes were sold. Family members stepped in. Others struggled. The income gap was immediate. Rent did not pause. Medical costs did not wait. The emotional toll was heavy but quiet. These were not speculative traders. They were people who had chosen safety because they could not afford risk. Being told they should have known better offered no comfort. In interviews, a common theme emerged: trust. The fund had not promised wealth. It had promised reliability. It had framed itself as a shelter from volatility. That framing mattered more than numbers on a page. Investigators emphasized warning signs: lack of transparency, vague explanations of returns, consistent income without clear source, pressure to keep money in place, difficulty withdrawing principal, changes in language from guaranteed to expected. None of those signs guaranteed fraud on their own. Together, they formed a pattern. The laddered structure was a key lesson. By staggering obligations, the fund avoided visible stress. Investors did not compare notes because their experiences were slightly different. Some were paid on time while others waited. The differences delayed collective awareness. The case highlighted how time can be used as a tool, not to generate value, to manage perception. As proceedings continued, the organizer maintained innocence publicly. Privately, the records told another story. The gap between promises and reality was too wide to ignore. The final outcomes would take years. Court calendars moved slowly. Appeals stretched timelines. Recovery, if any, would be partial. What remained was the aftermath. Financial advisors reassessed their practices. Some faced scrutiny for recommending the fund. Others had walked away early and documented their concerns. The difference mattered. Regulators issued advisories warning about private income pools targeting retirees. The language echoed what victims already knew. Safety claims require proof. Income must come from somewhere. For the widows, the lesson was harsh and irreversible. What they had sought was not growth. It was stability. They had chosen a fund that spoke their language. Conservative, predictable, designed for people like them. The laddered Ponzi did not exploit greed. It exploited fear of loss. In the end, the Widow Fund did exactly what its structure allowed. It moved money forward until it could not. It paid time instead of returns. It relied on trust instead of transparency. When the flow stopped, the truth surfaced all at once. The cost was not just financial, it was confidence in advisors, in institutions, in the idea that safety could be taken at face value. The warning signs were there, they often are. But for those who could least afford to lose, seeing them came too late.